Let's talk about the 5 worst types of ETFs or exchange-traded funds for those of you born in the 1980s, so the 35, 40, and 45-year-olds out there. I'm Dean Lulkin, investing veteran, private credit CEO, here to help you grow your wealth. We're going to talk about asset allocation, we're going to talk about excessive fees and strategies that are either too conservative or way too aggressive for your age and your folks that are in your 30s and 40s. The first type of ETF we're going to talk about is my least favorite, inverse or leveraged ETF. And you've heard of symbols like TQQQ, SQQQ, SPXL, and SPXS. These 4 funds give you 3 times the daily return of the NASDAQ 100 or the S&P 500, both to the upside and the downside. Why is this such a stupid idea to invest in these funds? Well, these ETFs are designed for short-term trading, not long-term investing. And so the compounding of these daily returns makes them a disaster for you to hold over time. It sounds sexy trying to triple the returns of your next door neighbor or your best friend, but a simple index fund investor usually come out on top. Why? Simple. When you lose 20% because you made the wrong call on that specific day because you had that feeling that things were going to go in the direction you thought they were going to go. Well, you lose 20%, and guess what? Now you need a gain of 25% to break even. Lose 30%, and guess what? A gain now is needed of 43%. But even dumber, lose 40%, and it's 67% that you need to make up that loss. A 67% rise in whatever instrument you've bet on. Now, it's very simple for you to understand that if you lose half of your investment, it's got to double to get back to break even. Now, you're going to feel much worse than you did before you lost the money. Remember how losing feels 2.5 times worse than winning feels good. That's called loss aversion. That means break-even points in our portfolios feel horrible when, in essence, you probably shouldn't feel so bad. What's another type of ETF that I hate for people born in the 1980s? Gold and crypto. Let me tell you why. So these are ETFs like GLD and BITO. Why are they bad? Well, commodities, and these are really commodities to me, kind of like oil or platinum or corn and soybeans. These ETFs don't generate income. These securities don't generate income. And they don't compound wealth like equities. Well, you're going to have a lot to say about this because we have to be careful when we look back at Bitcoin returns over the last 10 years. Boy, have they compounded people's wealth. We'll talk about that later. But mostly the commodities barely keep up with inflation. So at the age of 40, you need assets that grow. They don't just store value. And these commodities, they're often driven by speculation, not fundamentals. We can debate all day about whether Bitcoin is speculative or fundamental and why it's gone up so consistently. But I implore you, stick to your day job. Don't guess when the crowd is going to drive these commodities higher or lower. You're probably better off just going to the casino and playing blackjack. Now, you may not agree with me, no problem. I just don't want to see more than 5 to 10% of the portfolios of folks born in the 1980s dedicated to these types of assets. But hey, if you have 5% in GLD and 5% in BITO, or you hold some crypto on the side in a cold storage or wallet, God bless you. But again, keep it reasonable in terms of your total portfolio allocation. In terms of your overall allocation, you probably don't need more than 3 to 5 ETFs to have a very well-rounded portfolio. And if you really feel the need to stick a GLD or a BITO in there and hold a little bit of crypto, that's fine as well. What's number 3 on our naughty list? Well, high-dividend ETFs. So the examples would be like VYM, SPYD, or HDV. Why are they so terrible? I hear all the time about how wonderful dividend-paying stocks are. Well, when you're 35, 40, or 45, reinvesting dividends is great, but high-dividend ETFs, they favor the slowest growth companies most of the time, and those real estate businesses that are extremely sensitive to interest rates, which has been a terrible bet as interest rates have gone up. So you're going to sacrifice long-term compounding, forgetting that Warren Buffett his Berkshire Hathaway has never paid a dividend for any reason in its entire history. And most importantly, if you want to create a dividend for your stock holdings, you can create one synthetically simply by selling some stock, because there's no preferential treatment to dividends as opposed to capital gains today. Now, that may change under a different administration, but it's not going to change under Trump too. Fourth on our list, low volatility ETFs. Examples would be USMV and SPLV. Now, these are silly toys for those in their 40s to play with. It helps you to avoid volatility at the cost of lower returns, right? There is no free lunch in this world. 40 years old, your biggest risk is not taking enough risk, right? Most of us work at some business and do something other than invest professionally. So we need our portfolios to help us to get out of the rat race and earn enough return to be able to retire at a reasonable age, which I think should be maybe 55 or 60, not 65 or 70, unless you're just simply doing something you love. So in order to achieve that, a low volatility ETF just isn't the right solution. Number 5, long duration bond ETFs like TLT and ZROZ. Now again, 40-year-olds holding long duration bond funds are exposed to unnecessary interest rate risk with low yields. When the yield curve is flat or inverted like it is today, meaning that short-term interest rates are about the same as long-term interest rates when you look at the curve. So the 2-year and the 10-year are in similar places. Now, you don't want to hold bonds maturing in more than 2 to 3 years. Even money markets pay as much or more than these longer-term bonds today. So if you're holding cash, which I don't mind at all if you hold 10 or 15 or 20% of your portfolio in cash, but they may be reserved for big ticket purchases like a car or a home down payment. Now, you can hold those funds in safe fixed income. Otherwise, it doesn't make a lot of sense for most of us. And when you do hold those funds in safe fixed income, make sure that it's shorter term, not longer term funds.